Come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled The Tangled Web of Global Governance, How the Biden Administration is Ceding Authority over American Financial Regulation. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Today's hearing considers the recent onslaught of banking regulatory proposals, including the Basel III Endgame proposal from Democrat-appointed officials to massively raise capital requirements on an already well-capitalized system. That proposal stems from recommendations made in opaque meetings of the global governance body called the Basel Committee on Banking Supervision. To increase transparency within the Basel Committee, Chairman McHenry and I sent a letter to the GAO requesting more information and a report on the federal banking agency's role in the development of international standards for the Basel III Endgame. That report will be just the start in exposing international governance groups' activist pursuits across the global economic system and the control over U.S. regulatory frameworks by unelected bureaucrats. The Basel Committee is tied to the Bank for International Settlements, or BIS, and is part of an ever-growing tangled web of global governance bodies. Along with the Basel Committee and BIS, the Financial Stability Board, or FSB, and recently, the Network for the Greening of the Financial System, or NGFS, have more influence on and information about goals, intentions, and plans of U.S. regulatory agencies than does even the Congress. The tangled web of global governance bodies works behind closed doors in tight cohesion with U.S. regulatory officials and staff at the federal banking agencies. Staff from the Federal Reserve, FDIC, OCC, and Treasury work with those bodies to develop regulatory standards, write policy papers, and promote the goals of those global governance bodies, hardly consistent with American constitutional governance. Some federal banking agencies, some federal banking officials sometimes even receive compensation from global governance bodies for their work in those bodies. U.S. federal banking agencies are held to abide by commitments that those bodies require of members in their self-constructed and sometimes dynamically changing mandates. Congress and the American people do not know what goes on in the global governance bodies, and federal banking agencies provide little information. On July 18th, this subcommittee had officials from the Federal Reserve, FDIC, OCC, and NCUA testify about purported climate-related financial risks and what those agencies were doing with the opaque NGFS, a global governance body dedicated to climate activism, and with the Biden administration. Those officials showed shockingly little knowledge about what their agencies were doing within the NGFS. Yet the NGFS, along with the BIS, FSB, and other strands of the tangled web of international bodies, are playing growing roles in climate policymaking at the federal banking agencies. For example, the recent proposed federal principles for climate-related financial risk management align remarkably closely to those being pushed by the global governance bodies, as well as by the Biden administration. The recent climate scenario analysis experiment of the Federal Reserve's Vice Chair for Supervision directly responds to policy desires of global governance, whether it is appropriate or even constitutional for our federal banking regulators to cede U.S. sovereignty and import international standards into our regulatory system. And with that, the chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chair Barr, for holding this hearing, and thank you for our witnesses for joining us. Claims with its member banks alone. Given the increasingly global nature of the financial system, distress in one jurisdiction can easily spill over to other parts of the globe. So it's in our interest to have the highest quality regulatory standards adopted worldwide. We saw clear examples of cross-border contagion during the 2008 financial crisis and more recently during the COVID-19 pandemic, when global asset prices fluctuated wildly and financial firms were met by a range of responses from global regulators. Just as their foreign counterparts advocate for the interests of their respective jurisdictions in international discussions, U.S. regulators do the same by maintaining a seat at the table in these discussions. Second, banking regulators have no statutory obligation to adopt the recommendations of these international bodies, nor are they free to act on them as they please. As has been done with the Basel III Endgame proposal, U.S. regulators must follow the Administrative Procedures Act and other applicable administrative laws that ensure any regulatory proposals are adopted following the procedures laid out by Congress in a way that integrates shareholder feedback. That said, it is the role of Congress to oversee the activities of our financial regulators and to engage on the proposals they put forward. We do so by commenting on the proposals, engaging directly with regulators, and by holding hearings like this one today to have a chance to hear from stakeholders and experts. Our policies should support the competitiveness of U.S. banks of all sizes and support economic growth here at home, while also being responsible to known and emerging risks throughout the globe. Rising geopolitical tensions present threats to our trading partners and supply chains, and climate change poses unique risks to many communities and industrial sectors. As we saw with Silicon Valley Bank earlier this year, social media-driven bank runs and so on require a rational response across all jurisdictions. And so I look forward to hearing the perspectives of witnesses and those of my colleagues on this important topic. Thank you, and I yield back.
Thank you, Ranking Member Foster. And I see that the Ranking Member is not here, so we will move on to testimony. Today, we welcome the testimony of Mr. Brian Bosher. Mr. Bosher is Director of the Financial Policy at Americans for Tax Reform. I see also a fellow Wahoo. Welcome. Mr. Thomas Honig. Mr. Honig is a Distinguished Senior Fellow at Mercatus Center at George Mason University. Professor Christina Parajon Skinner. Ms. Skinner is Assistant Professor of Legal Studies and Business Ethics at the Wharton School at the University of Pennsylvania. And Ms. Renita Marcellin. Ms. Marcellin is Advocacy and Legislative Director at Americans for Financial Reform. We thank each of you for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Bosher, you are now recognized for 5 minutes for your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster, and members of the subcommittee. Thank you for the invitation to testify today. My name is Brian Bosher, and I am the Director of Financial Policy at Americans for Tax Reform. ATR is a nonprofit 501c4 taxpayer advocacy organization that opposes all tax increases and supports limited government free market policies. In support of these goals, ATR opposes heavy regulation and taxation of financial services. ATR was founded in 1985 at the request of President Ronald Reagan. I am here today to talk about the federal government's excessive regulation of the U.S. financial sector. In particular, I am here to discuss how international organizations such as the Basel Committee on Banking Supervision, the Financial Stability Board, and the network of central banks and supervisors for the greening of the financial system have and are currently influencing America's federal financial regulators, many of which are members of these international organizations. What is most worrisome is that the U.S. regulators, such as the Federal Reserve, Federal Deposit Insurance Corporation, Office of the Comptroller of the Currency, and Securities and Exchange Commission, are circumventing Congress and using these international consortiums as a baseline for determining how to regulate American companies. Overall, my concern is that the American public does not have a clear understanding of how decisions are made at these organizations and how our regulators use this information to regulate and supervise America's financial sector. Over the course of our nation's history, capital requirements have become increasingly more complex and burdensome. Regulations on top of more regulations has become the mainstay. But have regulators adequately accounted for the costs of the new regulations? Do the marginal benefits of increasing capital requirements outweigh the marginal costs? In my opinion, the answer is no. But the bigger question is who gets to make these decisions. For decades, central bankers from around the world have convened in Basel, Switzerland to construct frameworks for regulating banks. You might ask, where in federal statute does it say that U.S. regulators should convene with their international counterparts to determine rules for American financial institutions? The answer is that federal statute does not authorize regulators to convene with international organizations and then pursue the formal regulatory process under the Administrative Procedure Act. Ultimately, it is up to Congress to hold regulators accountable. We need transparency to understand how regulators are making decisions and to comport with the constitutional separation of powers. The capital standards adopted by the Basel Committee have wrongly taken precedence over the authority invested in Congress to legislate and determine the appropriate capital requirements for American banks. The Basel Committee, a regulatory consortium composed of global financial regulators, has influenced U.S. bank capital requirements even though it possesses no supranational authority or legal force. The Basel Committee's charter even admits that it does not possess any formal supranational authority. The U.S. government is implementing regulations for U.S. banks that are based on a framework designed by a coalition of unelected bureaucrats from countries around the world. It is concerning that U.S. regulators are taking international guidelines and imposing them on banks and ultimately the American public. The executive branch hijacked the rulemaking process by circumventing Congress. The executive branch enforces the law, it does not create it. In light of West Virginia v. EPA, regulators must tread lightly or wind up in a situation where they are facing costly litigation. For rules as economically significant as the recent capital requirement regulations, there needs to be clear congressional authorization. So far, Congress has not provided that clear authority. What is clear is that the executive branch has assumed so much power over the years that in certain cases, such as with climate risk and capital requirements, it has decided to assume the powers of the legislative branch and determine how to best regulate private American enterprises. The Fed is concerned about a race to the bottom. I am here to say that we should be concerned about a race to the top. Foreign central banks should not be the arbiters of the U.S. banking sector. This committee has worked diligently to propose legislation that is a big step in the right direction. Bills such as Vice Chairman Barry Loudermilk's American Financial Institution Regulatory Sovereignty and Transparency Act would hold regulators more accountable and prevent them from unilaterally implementing rules originally formulated by foreign entities with no supranational authority in the United States. Thank you again for inviting me to this hearing. I look forward to answering your questions.
Thank you. And Mr. Honig, you are now recognized for 5 minutes. I think sir, if you could turn on your microphone.
All right. Thank you, Mr. Chairman Barr, and members of the subcommittee for this opportunity to share my views regarding risk-weighted capital standards and their role in assuring bank resilience through the business cycle. In my comments, I will briefly discuss what capital is, just to level set its purpose, and compare the two principal methods, the leverage ratio versus the risk-weighted capital ratio, used to judge a relative capital strength of a bank. And I will argue that of the two methods, the leverage ratio is clearer and better measure. So equity capital funded by investors who seek a return on their money and accept risk of loss is the most stable funding source for the banking industry. Equity cannot run in a crisis, and unlike debt, is not in default if dividends cease. And equity absorbs losses before depositors and other creditors. Historically, the leverage ratio, equity to assets, has been the market's first means to judge a bank's balance sheet. It is a simple, understandable, and efficient way to measure investors' stake in a bank and its ability to absorb losses. However, starting in the 1980s with the goal of raising capital levels globally, bank supervisors from the major industrial countries, led by the U.S., agreed to develop a more risk-sensitive international capital framework. Rather than rely on the leverage ratio, they would assign risk weights to assets, adjusting the size of the balance sheet around their estimate and their judgment of relative risk. A loan, for example, would receive a weight of 1, while government debt would receive a weight much less than 1. A risk-weighted capital ratio is then calculated as equity to adjusted assets based on risk. I have long criticized the use of Basel standards. From the start, the risk-weighted capital framework was politicized and gamed. To get acceptance among nations, for example, risk weights were adjusted for sovereign debt, mortgages, and securitized assets. Models were and are arcane, sometimes manipulated, and often implemented differently among countries. In contrast to the leverage ratio, the risk-weighted capital ratio is opaque, difficult to understand, and costly to construct. For example, the recently proposed Basel III endgame that you mentioned required over 1,000 pages to explain, adding to the thousands of Basel instructions already in place. Its purpose is to adjust the risk-weighted standards to better capture two sources of risk, market and operational risks. I wager that few bank directors would understand its content. An inherent problem with the risk-weighted capital standard is that the weights reflect past events, are static, and too often are adjusted by supervisory judgment. This introduces political and special interests into the process. It misdirects capital and may incorrectly favor one group of assets over another. For example, in the past, low weights were assigned to high-risk sovereign debt, collateralized debt obligations, and other derivatives, encouraging growth in these assets and discouraging loans on assets assigned higher rates, such as commercial and industrial loans. The risk-weighted capital measure can also misinform the user. For example, as of December 2022, a year ago, the largest U.S. globally systemic banks showed an average risk-weighted capital ratio of 14%, suggesting a highly capitalized industry. However, judging these banks through the prism of the leverage ratio of 7% suggests more vulnerability to shocks. In truth, losses can spring from all asset classes. The losses at Silicon Valley Bank that you mentioned came from its government and government-guaranteed bonds, which had low weights, thus requiring relatively little funding using ownership capital. This is an example of why, when industry experiences problems, investors, the public, and regulators turn to the leverage ratio to judge banks' resilience. The leverage ratio will not end failures. However, it will enhance market discipline as it reveals ownership stake in the success of a bank and how much loss a bank can absorb and remain solvent. Finally, research confirms these kinds of conclusions. So while we are trying to get the rest of the world to raise capital, we should focus on the U.S. and what makes our banks stronger, because in the long run, the strength of your industry will decide who wins in the international competitive world. Thank you, Mr. Chairman, for your time, and I look forward to your questions.
Thank you very much. Professor Skinner, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for inviting me here to testify about the regime of international financial regulation. The U.S. bank regulators have proposed, among others, a rule to finalize the third Basel Accord in a way that will significantly increase the amount of capital that banks require, weaken their business model, and drive unknowable shifts in market structure. There's reason to be concerned with the bluntness of the so-called Basel Endgame rule, its costs and unintended consequences. While the contours of the rule are still very much in flux, it is a good time for Congress to exercise oversight of this nexus between these international financial regulatory bodies like Basel, the NGFS, the FSB, and the way that rule and guidance making is done in the United States. So with that big picture in mind, I'll focus my remarks today on how international norms that have developed among clubs of central bankers and bank supervisors can provide an opportunity for these U.S. bank regulators to end-run Congress. And specifically, I worry that today, participation in Basel, the FSB, the NGFS, may create space for regulators to bring home their own vision of the U.S. banking market structure. Banks that are made to heel to state control would allow regulators to accomplish myriad things that they can't do within the confines of the mandates that Congress has set for them. For example, transform banks into quasi-utilities or attempt to tackle climate change. So at the outset, I want to make clear that the post-World War II commitment and interest in international economic coordination has had tremendous and lasting benefits globally and for the United States. But one can believe in the power and merit of this manner of cross-border coordination while also maintaining fidelity to the U.S. rule of law. And today I'd like to explore that balance. Congress's challenge with these international financial regulatory groups is that they aren't based in treaty or any other kind of formal law. And so for that reason, it's easy for them to turn to mission creep, which is to say that they have the ability to continuously expand their mandates and functions, which in turn is driving a similar expansion in U.S. law. These organizations were designed to be groups for brainstorming, for the cross-pollination of ideas. Basel's often referred to as a standard setter. But for most of Basel's history, its members, experts about banks, would discuss and agree to basic minimum standards for the relatively anodyne subjects of capital and supervision. Since 2010, however, Basel, along with these newcomers, the NGFS and the FSB, have been pushing into new arenas, many of which require subjective value judgments, which are therefore political judgment calls. In particular, the amorphous mission to address financial stability risk has expanded these organizations' portfolios tremendously. The result is that today, the work streams of these groups may well provide a backdoor to or pretext for accomplishing objectives that are in the executive branch's agenda but have no statutory basis. Regulating to mitigate climate change is just one example. And consider 3 ways that preferences for supervising climate risk, as articulated at Basel and the NGFS and the FSB, may well find their way into U.S. law without congressional approval. For one, the Basel Endgame rule purports to reduce variation between banks' capital calculation of their capital charges. But what is the endgame there? European and UK banks have expressed some desire to eventually increase risk weights for brown assets and reduce them for green assets. So if the US subscribes to the principle of no variation, will we ultimately have to adopt that standard too? Likewise, the endgame proposal requires standardization in charges for operational risk, a risk which can very easily be expanded to include climate change regulation. Operational risk charges are meant to cover all manner of litigation and legal costs, losses from purported real or predicted physical and natural disasters, and ostensibly from policy transition risk. Finally, although the Fed's recently launched supervisory stress testing for climate risk has been piloted as voluntary, the expression voluntold comes to mind, and it's well known that the moral suasion of the supervisor can be a very compelling stick. Now, maybe everyone is acting in good faith, and certainly many are. But given the lack of statutory basis for implementing Basel's endgame, Dodd-Frank is now 13 years old, this recently proposed rule begs an important question. Either these agencies will follow Basel blindly off a cliff, or they find the opacity a convenient opportunity to deliver rules that aren't a good fit for the US economy and banking system, but do promote some political or special interest. Ultimately, we need to take a step back and see the forest through the trees. There are obvious reasons why European regulators need to coordinate in these forums. They're small jurisdictions and they're crucially interdependent. The United States has the strongest banking system in the world. And while coordination is important, the US is usually a standard maker, not a standard taker. And even when the US does shape standards in these forums, regulators should not be able to hide behind the opaque Basel or FSB process to justify what they've done and why.
Thank you, Professor Skinner. And now, Ms. Marcellin, you are recognized for 5 minutes.
Thank you, Chairman Barr and Ranking Member Waters and Foster and the members of the subcommittee for the chance to testify today. Americans for Financial Reform is an advocacy organization born out of the 2008 global financial crisis that continues to push for a more stable and equitable banking system. AFR strongly supports the Basel Endgame capital proposals put forward by the banking regulators and their work to address climate-related financial risk, especially as the world grapples with the dire effects of climate change. These efforts will lead to a more resilient financial system, a stronger economy, and put us on the path to effectively address the threats posed by a warming planet. Banks without the necessary capital to weather economic storms put their depositors, customers, and communities in jeopardy. Contrary to popular belief, capital is not money locked away in a vault unable to be used. Capital equals equity, which is the difference between a bank's total assets and liabilities. For non-financial companies, market forces usually determine how companies use their equity, whether it's reinvested in the company or paid as dividends to shareholders. However, given the unique role banks play in our economy, banks have special requirements on how much capital they need to retain. Banks are publicly chartered entities that help supply the money and credit the economy needs to thrive. Their failure negatively affects more than just their shareholders. Requiring higher capital levels helps ensure banks retain skin in the game. As many studies have noted, well-capitalized banks have lower funding costs compared to their peers because they have a lower likelihood of default. Countries that had better capitalized banking systems in 2006 experienced higher lending growth during and after the financial crisis. This all undercuts claims that higher capital requirements will hurt access to credit. Not only does the current proposal lower the amount of capital required to fund a bank's overall lending activity, but current or even proposed capital levels fall below what most experts suggest is optimal. Data from the Kansas City Fed, as emphasized in my written testimony, makes it clear that banks are well below capital levels that would begin to restrict the economy. The Basel proposal will increase capital requirements by only 6% on average for banks with more than $100 billion in assets and 19% for US G-SIBs. So less than 50 banks would be affected by this proposal. The frantic arguments against the proposals are an attempt to keep the status quo for less than 1% of US banks that enjoy outsized political and economic power, here and abroad. The United States is seen as the leader in the financial industry. And as former Secretary Stephen Mnuchin and Ranking Member Foster noted, much of Basel III was about bringing the European capital standards closer to those of the United States. The interests of American financial institutions can only be advanced if U.S. authorities participate in global standard-setting bodies. Additionally, international bodies have no legal authority here, and U.S. regulators still need to follow the standard notice and comment period before any Basel Accord becomes binding. International standards also help prevent a race to the bottom, usually sold as maintaining global competitiveness. But how we measure competitiveness should be more than comparing our banks' profitability to their global counterparts. And our quest to become competitive should not lead our banks to become a source of weakness in the global system as they were pre-2008. Our financial services industry is less competitive if we sacrifice proper safety and soundness measures, because doing so eventually leads to financial crises. American banks fared much better than European banks after the financial crisis, partially because U.S. regulators took decisive action regarding capital requirements in 2009. The U.S. should also be a leader in addressing the unique risk climate change poses to our financial system. While the Fed has started a pilot program to analyze climate-related risk for the 6 largest banks in the U.S., many other countries are far ahead of us. For example, the UK and the EU have published climate-related expectations for their banks and included climate change and stress testing for insurance companies, respectively. Thus, it is hard to see how the U.S. is ceding its authority to global regulators. Our policymakers need to create a framework for stakeholders to consider the financial risk associated with climate change. They should place the interests of taxpayers, workers, and the broader economy above those of a few shareholders. The Basel proposal and the broader work of the administration to address climate-related financial risk forces banks to prioritize their long-term growth and value in the real economy over riskier strategies for short-term financial gain. We look forward to working with members of this committee on these issues. Thank you.
Thank you for your testimony. And now we will recognize the ranking member for a 1-minute opening statement.
Thank you very much, Mr. Chairman. We're 10 days away from a costly government shutdown, and instead of working with Democrats to prevent that, Republicans are advancing funding bills that are dead on arrival because they slash critical funding and undermine agencies like the Consumer Financial Protection Bureau. And despite the bank failures earlier this year, Republicans have the audacity to hold this hearing to attack regulators for coordinating with their foreign counterparts to better promote bank safety and soundness. Given the global structure and nature of our financial system, it is important that our regulators engage through international organizations like the Basel Committee to ensure that the U.S. is providing leadership on strong safeguards to avoid a global race to the bottom, and so that we learn from others to address systemic risks like climate change. Thank you, and I yield back.
Gentlelady yields back. We'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Mr. Honig, your experience at the FDIC and in the Federal Reserve System includes work on developing and implementing U.S. regulatory, bank regulatory policies. You've also worked directly in supervising and regulating financial institutions. This committee held a hearing in July on purported climate-related financial risks and activities of bank regulators in the NGFS. In that hearing, we questioned high-level staff from the Fed, FDIC, and OCC. It appeared that even at the highest levels, exactly what goes on at the NGFS is not fully known by our own regulators. And that may also hold true for other global governance bodies such as the Basel Committee. In your experience at the Fed and FDIC, did you have full information about deliberations and negotiations at places like Basel? And were you involved as an official in signing any of the agreements or accords we hear about? I know the NGFS didn't exist in your day at those agencies, but do you think there's adequate transparency today?
The way those negotiations go, the staff are sent to Basel to discuss these issues with the others around Europe and worldwide. Those discussions go on in great detail for extended periods. When they come back, individuals may brief the chairman or the or the board itself. That is at the discretion of the board, and often that's not done until well into the finalization of the discussions. Then the board will be briefed, and if they are being asked to adopt this rule, they will be briefed on the rule at that point, and it's an up or down vote at that point. If you have objections, you would vote against it, but you really have no input until the very end of the process. The chairman may have more input than the other members of the board, but it's pretty much staff level until you get towards the end.
And by the way, I do appreciate your testimony about the complexity of risk weighting and the tendency that could lead to the politicization of bank capital requirements versus the leverage ratio you talk about. Professor Skinner, can you also speak to the opacity of the decision-making at these international bodies?
Yes. So as an academic, it's very difficult to know what the negotiating aims of any given participant will be and how decisions are taken up, how they're made, or which issues are pursued. What we do know as scholars who study these institutions is that the opacity, the lack of transparency, is a deliberate design choice. So when these institutions were formed, the trade-off was made to decrease or to give up on accountability and transparency in favor of agility, flexibility, and this clubbiness that was thought to inspire trust among its members.
And amplify your testimony about how regulators' participation with these international bodies could, in many ways, circumvent constraints that Congress would impose on those regulatory agencies and import foreign standards, especially in the climate area, foreign standards where Congress has not authorized those foreign standards.
Right. Well, as has been noted before, technically before any rule becomes U.S. law, it has to go through the APA process. But in some ways, it's an overly formalistic explanation of what goes on, because in the case of climate, for example, if standards are agreed at Basel, then, or capital risk weights, for example, oftentimes they'll create what is perceived to be or is actually a very sticky default. So those standards are brought home and then anchor conversations around what the Fed or the OCC or the FDIC should do. So in the specific case of climate, many jurisdictions around the world have much more open-ended mandates to address climate change than the Fed or the OCC does. So in an effort to be compatible with what their counterparts abroad are doing, the Fed or the OCC may in turn then sort of stretch the limits of their mandate to supervise for safety and soundness or for financial stability risk, to try and address things that Congress might not otherwise authorize.
Mr. Basher, should Congress or global governance bodies outside of Congress's purview play the predominant role in making and overseeing federal banking law?
No, they should not. There's not enough transparency with these international organizations. They are clearly ignoring Congress. They're not considering if Congress has condoned their actions, and they basically believe that they have full discretion to do whatever they want. And they do not, according to case law. They do not have unbridled authority, and this is a great opportunity, I think, for Congress to rein them in.
My time has expired, and now the gentlewoman from California, the ranking member, Mrs. Waters, is recognized for 5 minutes.
Thank you very much. I'd like to address this question to Ms. Marcellin. Earlier this year, we saw how quickly the banking system got into serious trouble when Silicon Valley Bank collapsed after experiencing the fastest bank run in United States history. We and the banking regulators worked through the weekend. Thankfully, Secretary Yellen, along with FDIC and the Fed, were able to take several measures on their own to stabilize the situation. As Congress examined what went wrong, committee witnesses, including Fed officials, highlighted that Silicon Valley Bank did not hold enough capital for its securities portfolio, which had large unrealized losses, and that SVB had to sell that portfolio at a steep loss to try to meet demands by depositors withdrawing their money. SVB didn't have to hold capital because a decade ago, our regulators, led by Trump, deviated from Basel III framework to allow regional banks to opt out from holding capital relating to a category called Accumulated Other Comprehensive Income, or AOCI, which includes a bank's securities portfolio. Trump's regulators made this worse by expanding how many banks could opt out, including banks like SVB. Ms. Marcellin, do you agree that U.S. banking regulators made a mistake by deviating from the Basel III agreement to allow banks like SVB to opt out from holding capital for their securities portfolio with large unrealized losses?
Thank you, Congresswoman, for that question. Yes, absolutely. And, the law that you point to that was essentially deregulatory for regional banks, we continue to see it wasn't just SVB, but, the string of failures, which mostly was contained to those regional banks because they did not have the safety and soundness measures, which was pushed heavily by the Trump administration to think that regional banks do not pose the level of systemic risk as larger banks have, and we saw the consequences of that. Thank you.
Thank you very much. Further, Ms. Marcellin, would you also discuss why Congress should not be discouraging, but rather encouraging the Federal Reserve, FDIC, and OCC to engage with their foreign counterparts on banking regulatory matters? For example, it seems like other countries are much further ahead in taking steps to address climate-related financial risks. For example, in the United Kingdom, their regulators included climate change in its insurance stress testing 4 years ago, and the Bank of England designed their 2021 stress test to aid their economy's transition to net zero and to analyze climate-related risk on capital requirements. Are there things our regulators can learn from them in determining how best to update requirements to ensure our banks are adequately considering and addressing climate-related financial risk?
Yes, absolutely. So first, our banks, even according to the Financial Stability Board, are the most globally interconnected banks. Regulators in there, and especially the Fed in fulfilling its mandate to, ensure safety and soundness, they need to be able to have insights into these banks' activities that frankly are borderless. And the only way to do so is to make sure that they're coordinating with their global counterparts. And, because of our interconnectedness, we also have unique risk in that we have to consider, counterparty risk of various countries, various banks across the world. And again, the only way to fully do that comprehensively is to engage in these global standard setting bodies. And to the point of climate risk, it's a global crisis. It's a global phenomenon. To think that one country on its own can solve that or can address it without working in tandem with others, would be a mistake. And as I noted in my testimony, if even for our banks, for them to continue to be global players on the scale, they have to want, it's in their interest to have the regulators continue to participate in these bodies. Thank you.
Thank you. So basically what we're concluding, and perhaps you are too, that our hesitancy does not help us to understand creative ideas and new ideas and ways by which we can deal with climate change.
Yes, exactly.
Thank you very much, and I yield back.
Gentlelady yields. The gentleman from Florida, Mr. Posey, is now recognized.
Thank you very much, Mr. Chairman. Cutting right to the chase, Mr. Basher, do you think it's beneficial to the United States to let foreign bureaucrats dictate our financial standards?
No, it's not beneficial at all. This is, unfortunately, I feel like that over the past few years that a lot of legislative power has been ceded to the executive branch, and I think that needs to be reined back in. The Basel Accords have never been ratified as a treaty, not as an executive agreement. There's no reason that the Fed should be using their discretion like this to pursue something that has not been clearly authorized by Congress.
Mr. Honig? Dr. Honig?
I understand the need for cooperation in the international world we live in. My concern is that when we talk about it in the Basel III framework, we are now politicizing the whole process. And so it's how you influence the outcome at these negotiations at the staff level, and how they come back and are talked about in the board meetings and so forth as you go forward from here. It is opaque. And so you hear about, the foreign interests think that we ought to have accounting for green. We ought to have risk weights for green energy. Well, that assumes that the regulators have more knowledge than they have to be able to assess what that risk is. And then they put it in this risk-weighted system that is opaque, difficult to understand, and you then can misallocate. So do you put higher risk weights on energy that is carbon emitting, and then do you favor green energy? So now you're directing capital resources within the industry under the banner of a risk-weighted capital system, and I think the outcomes are often perverse, and you actually get worse outcomes than you would if you just said, here's how much capital the industry has to have. They have to allocate it in their own best interest. And I can tell you, the banking industry has been dealing with climate issues for centuries. I mean, they're going to adjust to these effects in terms of their own risk-taking, and the industry can do it as well as or better than a centralized authority assigning risk weights through a very complicated, opaque, and often totally ununderstandable framework, which is called Basel III.
Thank you. Professor Skinner?
No, I don't agree that it's appropriate to cede authority, especially now, because I think where the rubber meets the road is that these organizations have crossed over into territory which is now politically contested among jurisdictions and is involving choices that are inherently fiscal in nature. Who wins and who loses in an economy? Those choices have to be made by a legislature, not by unelected central bankers, whether that's domestically or internationally. And right now, climate is the signature example of that, but you could imagine other examples down the road. And because there are no clear rules in US law about what the parameters are for these organizations' mission and function and mandate and how the US is to engage, not only is it very difficult to see into the decision-making process, but it's also very difficult to rein it in.
Thank you, Mr. Chairman. I yield.
Gentleman yields. The gentleman from Illinois, Dr. Foster, is now recognized for 5 minutes.
Thank you, and thank you to our witnesses for being here. One of our duties in Congress is to respond to the world as it actually is, rather than the fever dreams of some sort of, takeover by world government. And so let's do some level setting here. Ms. Marcellin, first, what statutory obligation do U.S. regulators have to automatically implement the recommendations of these organizations? Can Basel III simply order U.S. banking regulators to pass rules?
Thank you for that question. No, Congressman, there is no statutory obligation they have to implement any of this. And actually, as we've even seen with this latest proposal, they usually make significant tweaks to the proposal to adapt to the U.S. Market and size before they try to implement it here.
Yeah, and to the extent that they actually represent sort of best practices that are adopted internationally, does the U.S. see some value in having its banking regulators at the table there in producing, for example, the Basel III Endgame and other standards of best practices?
Yes, absolutely. One example that we could point to, as been brought up by other witnesses, are the supplemental leverage ratio. That, going to the original Basel III, was actually one of the advents of U.S.-based regulation that even former Secretary Treasury Geithner said that expanding to just have a simple, clean supplemental leverage ratio that includes off-balance sheets exposure was really something that the U.S. pushed for, and you see got implemented in other countries, and that the Basel Accord took into account when forming their various accords.
Thank you. Mr. Hennig, I sort of have shared in the past your dream that you can make just an objective set of numerical standards to define capital positions of banks. But, in reality, most of the impact of the Basel III is going to be operational risk for the giant banks. That's numerically about roughly 80% of it. And this is necessarily subjective. that, for example, is it obvious to you or any one of our panelists how much capital we should hold against AI-driven deepfake impersonations destabilizing our system, or should we ignore that risk? Is it obvious how much capital should be held against the risk of quantum computers breaking public key cryptography, shutting down SWIFT, shutting down the internet, basically? And so is it really, your advice that there is some objective way to set bank capital requirements?
Well, certainly, I don't think Basel is a way to do it because it assumes knowledge that they don't have. They assign risk for operational risk. Is it the right level? Have they done too little or too much? Do they assign risk to the loans at one and others at half of that much? So you encourage capital to flow to the less heavily weighted activity. You get all these distortions, and you also get politicization of the whole process. As you negotiate at Basel, it's what your country is looking for, what they want is favored, and you have these negotiations. I understand that you cannot identify individual risks. That's the whole point. You have a set of capital that the banking industry has to allocate. They have to allocate based on their understanding of risk, and yes, the supervisors come in and double check that, but they're not telling the banks how to allocate that to their perception of what risk rather than what the market perceives as risk and what experience and history says. That's why the leverage ratio, while it is simpler, it's also clearer. If I know you have only 7% capital that you can afford to lose before you're insolvent, then I know something. If I tell you you have a risk-weighted ratio of 14%, 14% of what? So half of the balance sheet is weighted, and the other half is equivalent of risk-free. I don't have any information there that is really helpful. So I think you have to understand that the banking business is a risk business, and how much capital they have is important. So let's have the argument over what's enough capital that the banks can absorb loss, rather than how much we allocate to green, how much we allocate to loans, how much we allocate to collateralized debt obligations, which no one can really tell you. So you're in this opaque world, and that's where you get the opportunities for abuse and for game playing among countries and within countries. That's why it's a very bad choice.
All right, well, thank you for your words, and yield back.
The gentleman from Missouri, Mr. Luchtenmeyer, the chairman of the National Security Subcommittee, is now recognized.
Thank you, Mr. Chairman, and welcome to our panelists. Mr. Honig, good to see you again. Thank you for your insightful comments and your many years of regulatory leadership. First question's for you. You were talking a little bit ago about all of the different machinations of this Basel rule and how it's implemented. To your knowledge, has there been a cost-benefit analysis done of this rule and the rules that were being implemented as a result of Basel III?
Not to my knowledge. There's been no specific cost-benefit analysis. Benefits of a leverage ratio far outstrip that of the risk-weighted capital measure. But beyond that, as you impose these rules, I mean, we're talking hundreds of millions of dollars in terms of the regulatory agencies. They have specialists on this, the banking system trying to meet it. So it's a very expensive, and no, I have not seen any real cost.
If we don't know what it's going to cost, why are we implementing this? Is there another agenda, perhaps?
Well, I think it's one of these things that originally it was designed to try and get the international community to raise capital. That's why it was.
Okay.
And so I don't know that that's been achieved. If you look at the long history of
Professor Skinner, you nodded your head a minute ago on my comment. Would you like to elaborate on that?
On which part?
Professor Skinner.
Well, it seems to me that the direction of travel for the Basel Endgame rule is to give the regulators more control over defining what is a credit risk and therefore to whom and against what assets banks should lend, rather than having the banks make that decision for themselves.
It looks to me like we're kind of in a modified choke point situation here, Operation Choke Point, where they're able to use these new rules and regulations to hit the banks over the head and modify their business model to make to satisfy the regulators' point of view and their activism toward a green economy. Mr. Bashir and Ms. Skinner, you both made comments with regards to the questionability of where this rule really came from the standpoint that it didn't come from Congress. In order for the regulators to have authority to promulgate rules, it needs to come from Congress. They can't pull this out of the air. So would you like to elaborate just a little bit more? How are they justifying the ability to take rules from other countries, impact our system, which is the finest in the world, and bring it down to their level with these new rules? Because we didn't authorize this to happen, I don't believe. Can you clarify that, please?
It's a big hole in the rule. The ostensible statutory basis is the Dodd-Frank Act, which authorized, of course, the implementation of Basel III back in 2013. And this is sort of being presented to the public as the finalization of the Basel regime. And as I noted, Dodd-Frank is now 13 years old, so it's implausible that that's continuing to provide a statutory basis. It seems also that part of the rule is motivated by the events that transpired in March of this year with SVB, but of course there's no statutory basis for a rule.
Are those rules not supposed to be administered in the Administrative Procedures Act, though?
The rule that's been proposed will have to go through the Administrative Procedure Act.
Isn't part of the Administrative Procedures Act having an economic analysis done?
Well, there are different forms of cost-benefit analysis that regulators are required to do, and a lot of times regulators will do cost-benefit analysis as good regulatory practice, but claim that they're not technically required to do a cost-benefit analysis.
Mr. Honig just said he doesn't think they're doing it at that level. Mr. Brasher, would you like to elaborate a little bit on that?
It could be that they're trying to use the International Lending Supervision Act as some sort of legislative authority, but the problem with that is that that was in response specifically to the Latin American debt crisis, and that was specifically to tamp down on potential risky international foreign debt specifically. This rule goes far beyond that. And
It would seem that the regulators are trying to become activists instead of regulators. My thought process about the regulators, having been one many, many years ago when Moses walked the earth, was that they should be enforcing the existing law, not making up new rules and regulations as their own ideas and political bias allow them to do in certain situations. Again, we have another situation here in my mind. If you don't do the economic analysis of this, it's like the Cecil situation. I told everybody when this is going to happen, it's going to be a really bad situation because you can't have two banks sitting across the street from each other, have different economic models or justifications for the way they analyze their loss categories. And now you have a situation here where we haven't done our background, haven't done the analysis on this, have no idea what we're doing, and yet we're going to push this rule and these rules on our banks and not knowing the unintended consequences of this. This is asinine. This is crazy. This is asking for trouble in my mind. Mr. Chairman, with that, I yield back.
Gentleman yields. Gentleman from California, Mr. Sherman's recognized.
What am I?
The gentlelady from New York
Thank
is
you,
recognized.
Mr. Chairman. Ms. Marcellin, the purpose of the Basel III Endgame proposal is to improve the resilience and stability of the global banking system. Critics of the proposal say the rule assigns too much risk weight to small business loans in standardized models. As ranking member of the Small Business Committee, I am always concerned about small businesses' ability to access capital. Can you explain how regulators address this concern?
Yes, thank you, Congresswoman Velasquez, for that question. In the Basel proposal, which has moved away from what was previously known as the advanced approaches to now taking a more standardized approach, this current proposal actually will lower the capital requirements required for credit lending overall, the credit risk weights. Furthermore, as I've mentioned in my testimony, written and oral, many studies have suggested that well-capitalized banks actually do more lending, especially when you account for the entirety of the business cycle. Because during hard times they're able to fall back on a cushion than banks who are less capitalized. And again, going back to my point about capital not being money in a vault, unable to be lent, it's just a matter of how they're sourcing their activity, whether it be through debt or whether it be through equity, and that money is not sitting somewhere that can't be put to use for the economy.
And the proposed rulemaking includes a significant on-ramp for compliance, including 2 years for the largest banks and another 3 years until 2028 for Category 3 and Category 4 banks. Can you explain how this will limit harm to the availability of credit for small businesses?
Yes, absolutely. It gives the, banks through their compliance, through their banking relationships with small businesses, it gives them a time, again, taking into account what I said, that the risk weights are actually reduced, but it gives them time to, adjust for their business model being impacted by these rules. And also, I want to reemphasize that this proposal is really limited to less than 50 banks, right? Most of small business lending relationships are not with, the GSIBs of the world. They're with community banks, and hence why, we want to stress the importance of community and small business relationships and having diversity in our banking sector.
And to put this issue to rest, isn't it true that community banks provide the majority of small business loans in this country?
Yes,
And community banks are exempted entirely from this proposal.
Yes, community banks are entirely exempted, and I believe they do provide a very material source of funding for small business loans. Thank you.
Ms. Marcellin, earlier this month, the Federal Reserve published its Financial Stability Report for 2023. In it, the report states, and I quote, "The attack on Israel in conjunction with Russia's ongoing war with Ukraine has escalated political tensions. These tensions pose important risks to global economic activity, the global financial system, and we could see declines in asset prices and losses for exposed businesses and investors in the U.S." Would you agree with the Fed's report?
The Fed are really experts on, analyzing geopolitical and macroprudential risk. So, I would defer to them on what they, and that's their mandate, on what they believe is, risk to financial stability. So absolutely, another reason why, capital is important, because it helps to account for these various things that are really outside of any one bank's control.
And do you think now is the time to pull back from the international arena, as some on the other side of the aisle seem to be arguing?
Oh, absolutely not. As evident by the multiple global crises happening at the same time right now. Whether it be climate change risk, whether it be what's happening in Ukraine or Israel and Hamas. It's just our standing as a global leader right now is too important to pull back. Thank you.
Thank you. Mr. Chairman, I yield back.
Gentlelady yields. Gentleman from Texas, Mr. Williams, Chairman of the Small Business Committee, is recognized.
Thank you, Mr. Chairman. Thank all the witnesses for being here today. And despite Chairman Powell's asserting before this committee that the Federal Reserve is not and will not be a climate policymaker, his agency's actions have shown otherwise. The Federal Reserve, the FDIC, and the OCC have proposed guidance and principles for financial firms on climate-related financial risk management. This is concerning as financial regulators under the Biden administration are calling for climate policies to be included in banking regulations, which extends the federal banking system beyond its intended purpose and threatens agencies' long-term independence. So, Mr. Basher, what are the consequences of the Federal Reserve becoming political? And given the Fed's recent efforts surrounding climate-related risks, do you think the Fed is going down the path of becoming a climate policymaker?
Yes, I think they're becoming much more amenable to being a climate policymaker. I think that's evidenced by the interagency guidance that was released just a couple of weeks ago, that they issued as just guidance and not going through the formal APA process. I think that this consideration of climate risk is just along along the race to the top, in that we started with credit risk in Basel I, then we added market, derivatives risks, operational risks. Now we're potentially adding climate risk. So where's the end? And I think that that's the problem. Maybe there is no top. Maybe it's just on to infinity. And I think that is the concern. And I think that if this stays the course, it's just going to be more regulations after more regulations. And we do not want, while we obviously there need to be safeguards in place, we don't want to see the banking sector in a situation where they become basically utilities.
Yeah, I'm a small business owner. It comes back to hurt small business in the end, too. The Basel III Endgame's proposal's goal was to promote parity across jurisdictions. However, I have concerns that other countries such as China, the UK, and the rest of Europe are implementing select parts of this proposal. The decisions by federal regulators to pressure the U.S. to implement more stringent standards than the rest of the world will create an unlevel playing field with financial institutions and constrain GSIBs in the United States. The gap between U.S. and the European capital levels will continue to grow, and the consequences of these decisions will drive adverse and unwelcome changes to market access and the availability of credit. Ms. Skinner, can you expand on whether the Basel III standards will create a competitive advantage for European banks? And what will the effects of this European advantage be on the American public and our domestic banking system's competitiveness on the world stage?
Thank you for the question. Well, certainly the Europeans have looked at the Basel III rule and decided that some of it is not for them because they're concerned about the competitiveness of their banking sector. The European Union has for a very long time tried to model what the United States has done with its capital markets through its initiative for a capital markets union. And to that end, the Europeans are planning to implement Basel III in a different way that will continue to stimulate corporate lending by assigning a lower risk weight or making it easier for certain loans to small and medium-sized businesses to have a lower risk weight, where we are going about this business of gold plating or platinum plating, if you will. And I think it will put the United States on a very different competitive field from the European Union and from the UK. Even after the 2008 financial crisis, when the UK was implementing its various sort of equivalent of the Dodd-Frank Act, various senior level bank regulators had this expression, we want to avoid the financial stability of the graveyard, which is to say financial stability is important, but we're not going to regulate our banks to death so that we no longer have a competitive banking sector. And now the Bank of England has a mandate for competition. And so it's going to be thinking about how it will implement Basel III in a very different way from the United States.
Another where we're giving our leadership up. Mr. Basher, quickly, my last question, I'll get to it here. Could you elaborate on how Basel III proposal will impact bank lending and the risk and the cost of credit for borrowers? And finally, what does this mean for small businesses like mine in Texas trying to obtain a loan?
It'll increase the cost of credit because the ratios are equity to assets, and if you have to increase the numerator, then it's going to make it a lot more expensive for borrowers to get access to that credit, especially small businesses. And I think there have been a few surveys out there that have actually said that a lot of small businesses are concerned about the tightening credit conditions from this rule.
Well, and put interest rates on top of that, it gets even harder, doesn't it?
Yes, absolutely.
Yeah. Chairman, I yield my time back. Thank you all for being here.
Gentleman yields to the gentleman now from California, Mr. Sherman's recognized.
Thank you. If our standards are too low, we're going to see bankrupt banks and bailouts. If our standards are too high, we're going to constrain economic growth and especially constrain small business lending. Our standards are higher than those of Europe, and that ties to a different insurance system. In Europe, deposits, I believe, are insured to 100,000 euros. Here, it's to $250,000, more than twice as much governmental involvement in securing depositors. While you can argue for lower standards, you can argue for higher standards, you can't argue for stupid standards. And I think when we get involved in some of these details, I want to illustrate that some of these standards don't meet an intelligence test. But we should not call these European standards. The responsibility, positive or negative, belongs to the three major U.S. regulators. They're just waving the Basel flag when they want to do something and saying, oh, the Europeans are suggesting it. And then when the Europeans suggest something they don't like, they ignore it. As Bill Foster's questioning demonstrated, all the power is with the U.S. regulators. And if these regulations are good or bad, that's entirely the result of Americans. Yes, we listen to foreign regulators. We also listen to economics professors, neither of which are mentioned in the U.S. Constitution. How we allocate capital is important, particularly big versus small loans. What seems to be favored in our society is people in $1,000 suits making $1 million a year and making billion-dollar and multi-billion-dollar investments in securities. What is downplayed, and those people always have fancy fancy business degrees. What is disadvantaged is Main Street loans to Jack's Pizzeria. And needless to say, our regulators favor the first group because they all have fancy degrees too, and they like to look at big pictures, and who wants to go down to Jack's and sample the pizza? So when we have credit risk, the small business has credit risk, and we are all focused on that. The interest rate risk, which is what took down Silicon Valley Bank, we give short shrift to because, after all, those are the decisions made by the big fancy people with their big billion-dollar bets and their big fancy degrees. Having an economy that is weighted toward the giant loans is I think, really a bad idea. Now, speaking of stupid regulations, can anyone here please raise your hand if you can even come up with an argument, half an argument, for the idea of ignoring private mortgage insurance in evaluating the risk of holding a mortgage loan? I'm looking here. None of you can even come up with the slightest argument in favor of that incredibly stupid idea. Okay. Ms. Marcellin, you talked about the importance of climate risk, and yet these new Basel rules increase by a factor of 4 the risk associated with the tax equity investments for green energy. I don't know if your organization has focused on that. You focused on other aspects affecting climate. Can you think of a reason why we should adopt regulations that penalize banks for being involved in the tax credits designed to encourage green energy?
Yes, thank you for that question, Congressman Sherman. So, first and foremost, I do want to say that mitigating climate change and
Excuse me, I'm talking here about just one little detail, and that's the tax credits. Are you for clamping down on banks or against clamping down on banks that invest in these tax credit projects and give us clean energy?
the largest banks that do this are JP Morgan and Wells Fargo, and they are benefiting off of the tax credits.
Right.
Yes.
That was the intention when we passed the law. Should we now penalize them through the bank regulatory system for doing that?
I don't know if I would characterize it as penalizing them, but I think it's,
I do want to try to squeeze in one other thing, and that is that the rules for, quote, high-quality corporate exposures are once again in Basel designed to discriminate against making those Main Street loans and push banks into making the billion-dollar loans and the securities. And perhaps we should have a rule against having anybody involved with having too many people with elite degrees making these rules, and I yield back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman, is recognized.
Mr. Heinig, I found it interesting. I think, did I hear you right? I may have come in late when you mentioned that people, as it relates to Basel, you have people making decisions that really don't have the knowledge base to back them up.
That's correct. I mean, you have regulators who not experience assigning, in a sense, allocating capital across the bank's balance sheet.
Yeah, and evidently the board of directors are letting that go. I'm in the real estate business and been in it for a long time. We faced the biggest crisis we faced in a long time as far as Roger Williams mentioned, getting capital to fund projects that are the dollars that are going now to build projects are out of the roof if you can get the products to build them. So how do we bring, as it relates to that, you've got, the federal banking agencies issuing these principles for financial institutions to manage exposure to climate risk. Can you define what and I know the tax credits and what else are they imposing on banks that's going to ultimately cost the taxpayer and the borrower?
Well, there's all kinds of things. In the proposal, there's rules that would modify the relative weights for some mortgages in an effort to make the smaller banks more competitive with the larger banks. I mean, that has nothing to do with financial safety and soundness. It has to do with someone's view that someone should be more competitive, so you're allocating your rules to influence behavior. And that's the problem with Basel. It is having the central authority, the regulators, allocate capital among uses on the bank's balance sheet, rather than the banks doing it and the regulator making sure that they're doing it under safe and sound practices, underwriting practices. They're now directing where credit goes.
And the sad part about it, the regulators don't have the knowledge or the experience to make those kind of calls. That's the bank's call.
That's correct.
They're the ones that have to answer the stockholders
That's correct.
and the shareholders.
That's correct.
How do we bring everything's secret. If you look at I was just looking here, the global governance bodies, they have secret meetings. How do we publicize that? How would you suggest we see what goes on behind the closed doors?
Well, they're having these meetings to discuss these capital rules. And as to my knowledge, there are not minutes kept of those meetings, not transcripts kept of those meetings. And if you want to bring it forward, you would require that if the U.S. engages in these conversations, that there be minutes of it or records of it, and that those be available to the public.
And that's Congress's role to put that in place.
I think Congress is the one that has to do it. Yes.
We're really the only ones that can do it. They're the only ones that ultimately answer to it.
That's exactly right.
I guess my other concern, Mr. Basher, we've been asked questions about the Bank of China, Central Bank of Russia, being involved in our financial institutions with ownership, all of our secrets being shared. How do we deal with that from your vantage point, and really any of the other three as well?
All the more reason why we need transparency and copies of minutes so that we know if the Chinese or the Russians, if they're saying, oh, we want this provision in the accords or we want to remove this provision, we need to be able to see that. And we can't currently. And that would, I think, give us a much better idea of how, specifically which countries are asking for what kinds of provisions in these regulations.
Ms. Honig, you have any comment on that?
I don't have any additional comment than what I've already made.
Well, thank each one of you for testifying, for being here. It's very important. So goes the banking industry, so goes the economy. And we've got some real headwinds we're facing. So, Mr. Chairman, I yield back to balance of my time.
Gentleman yields. The gentleman from Georgia, Mr. Scott, is recognized.
Thank you, Chairman Barr. Appreciate that. Ms. Marcellin, I want you to know that I believe the Federal Reserve is being pulled in two separate directions. On the one side, the critical strengthening of our banking system, but on the other, preserving the ability for underserved African Americans and other minority borrowers to obtain a mortgage and purchase a home. Now, I support both of these goals, and I have yet to see how the Fed will ensure that Basel III Endgame does not unduly affect mortgage lending, and in particular, mortgage lending to those who need their help the most. So, Ms. Marcellin, do you agree that if enacted, that the mortgage lending provisions in Basel III will require our nation's largest banks to hold significantly more capital against those types of mortgage loans, and specifically speaking, for the borrowers with a down payment of less than 20%?
Thank you for that question, Congressman Scott. I certainly understand the concern. I want to say that non-bank lenders actually account for more of home purchase loans than the largest banks. They are the primary source of credit for low and moderate income communities and BIPOC communities' mortgages as well. I also want to reiterate that when capital requirements were lower for banks weren't exactly lending, in throws to Black and brown communities. We have about 400 years of systemic racism as to why banks were choosing not to lend to Black and brown communities, and I'm not sure if this specific requirement here, especially when they're exiting the market in throws, will actually have much of the overstated impact on Black and brown home ownership as claims have been made.
And so tell us, how do you anticipate that this will impact the bank's incentives to make these loans to low-income Americans?
You know, I think it can have an impact. I think that the Fed, even in their proposal, has signaled, and you know, the other prudential regulators has signaled that they are open to also maintaining the current risk rates, which I believe is 50%, 50% for low-income borrowers. So, you know, again, this is something that I'm happy to work with your office and, of course, with the regulators about. But I do want to be careful about harping or using this as a distraction to the overall goal when these banks are not really lending to, you know, people like myself in the first place.
Absolutely, and we have to be very careful to make sure that it does not have this outsized impact on those who need the help the most. Now, Mr. Bashar, I'm aware that recently Fed staff hinted at the possibility of adjusting the new bank's capital rules impacting mortgage lending. What kind of adjustment would you recommend that they focus on?
I would recommend that the regulators leave it to the banks to decide what is risky and what is not. And I think that they already have to comply with Community Reinvestment Act guidance and federal statute. And so I think by rolling that back in the bank capital rule would give banks the opportunity to assess the risk and comply with statute that's already on the books.
Well, thank you for your response, but I must say that much like Chairman Barr and other members on both sides of the aisle, my concern centers on how even a well-intentioned proposal could further reduce borrowing costs for wealthy individuals at the expense of low and middle income people. Thank you, Mr. Chairman.
Thank you, Mr. Scott. And the gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you, Chairman Barr, for holding this important hearing, and thank you to our witnesses for being with us today and taking time out of your schedules to share with us. It is clear that Congress is not brought actively into the process before U.S. regulators take up implementation of international standards such as the recent Basel III endgame. In most instances, these international standards are a foregone conclusion even before a U.S. proposal is formally issued. Mr. Bashir, how can Congress improve its oversight of U.S. engagement with the international standard setters?
I think you need to require the U.S. regulators to submit minutes, to come in, to submit reports, to come in and testify, to engage with Congress and it could be, you know, closed-door meetings, just so that Congress is fully aware of what's going on and Congress can assess, and if Congress wants to write legislation, additional legislation to dictate certain capital standards, then they can do that.
And you would suggest that legislation be put in place that requires that consultation in advance and keeping Congress abreast of what's happening?
I would recommend if Congress wants to be engaged in the capital requirements process, that they need to write legislation to do that themselves.
Okay. And Ms. Skinner, in your written testimony, you state that Congress cannot abdicate its legislative power by excessive open-ended delegation. I completely agree with you, but I am profoundly worried that the Biden administration believes just the opposite. I'm worried that the Biden administration feels that they can usurp Congress's legislative power through the implementation of international standards like the Basel III endgame. Ms. Skinner, how can Congress forcefully assert its status as the sole legislative body in this country and improve its oversight of U.S. engagement with international standard setters?
Thank you for the question. So I think there are a couple of ways. To start, if U.S. regulators are planning to engage in these forums to create concrete standards, supervisory principles, Congress should insist that there's a clear statutory basis for these regulators approaching these forums and developing these standards. Second, I think Congress may wish to set some parameters or push back on the regulators' participation in some of these forums in certain contexts. And I think participation in the NGFS is a good example of that. The Fed, unlike many of the other member participants, does not have a mandate to proactively tackle climate change, not with its balance sheet, not with regulation, and ideally not with supervisory suasion.
Thank you very much. Mr. Bashir, as you are aware and highlighted in your testimony, your written testimony, there are multiple Chinese entities that are members of the Basel Committee, such as the China Banking Regulatory Commission. I know you've already touched on this, but I think it bears reiterating. Given that Chinese entities sit on the Basel Committee, how can we be sure that the government of China is not playing an outsized role in setting international standards that could ultimately be adopted by Biden-appointed U.S. regulators?
It's possible that they are playing a large role. We just don't know. But I think what also is really concerning are the peer reviews that these agencies perform. The IMF, FSB, and Basel all perform reviews. The FSB actually says to use the IMF peer reviews. Then those IMF reviews use the Basel metrics for supervision. And so I think that a lot of the regulators are concerned about, or more concerned about, the peer pressure from these international organizations that have the China and Russia members than they are. They're more concerned about them than they are listening to what Congress wants and what the elected representatives of this country want.
Thank you. And Mr. Bashir, your written testimony also discusses the influence of state-sponsored entities such as those affiliated with China, Russia, and the Basel Committee, the Financial Stability Board, and the network of central banks and supervisors for greening the financial system. Is there enough information available for the American public to determine how much influence the governments of China and Russia are wielding at these international organizations?
No, there's not enough information available. We need legislation to get that transparency.
And finally, what steps can Congress take to promote greater transparency into the role that state-sponsored entities play at these international organizations that are unaccountable to the American people?
So the committee already has legislation that they passed through markup already, Vice Chairman Loudermilk's bill, which I think is a great first step. Once you can get that transparency and actually see the minutes and the reports and the discussions that everyone's having, then you can go from there.
Thank you. I yield back.
Gentleman from California, Mr. Vargas, is recognized.
Thank you very much, Mr. Chairman. I'd like to make a grand entrance.
You did.
Mr. Chairman, thank you and the ranking member.
You always do. You always do.
I want to thank you and the ranking member for this hearing, and especially the panelists. Thank you for taking your time to be here. I appreciate it very much. You know, the question has been thrown around, or the issue of climate change has been thrown around here by almost everybody. So why don't I ask just the basic question? How many people here believe in climate change? And Mr. Brashad, why don't I start with you?
So I'm here representing ATR, and ATR does not weigh in on climate science or climate change.
I'm just asking, do you believe in it then?
Right. I'm here representing Americans for Tax Reform, though.
So
we don't weigh in on the issue of climate change or climate science.
That's been brought up by a whole bunch of people here today. But you don't have any opinion, your group doesn't have any opinion on climate change, whether it's real or not?
ATR does not weigh in on that issue.
So even though so much of this hearing is on the basic of climate change, whether it's real or not, you're not going to comment on that?
I can clarify. So we weigh in where the government is issuing subsidies with regard to renewables as it relates to that, or as it relates to the definition of materiality that the SEC uses. But in terms of the actual, like looking at climate models or climate science, we just don't weigh in on that.
Okay, thank you. Mr. Honig.
I think there's a real issue with climate change. I don't know what the degree of it is, and neither do the regulators. I don't know what the timing of it is, and neither do the regulators. As I said earlier, banks have been dealing with climate issues for centuries, and they learn, they adjust, and they adjust their own internal risk analysis for that, and that's what we should rely on. And we have a supervisory framework to judge how much risk is out there once they make the loan and how the loan performs. That's the best.
But you think it's real?
Pardon me?
But you think it's real?
it is a real issue for this country and for the world. Yeah, it's a real issue.
That was my question. Thank you. Professor Skinner.
Thank you for the question.
Of course.
I believe it's important to study climate change. However, one can separate the question of the scientific basis and evolution of climate change from the question of whether it's appropriate for our U.S. financial regulators to proactively attempt to mitigate climate change using their supervisory tools with the existing mandates that they have.
Fair enough. Do you believe in it?
I believe that climate change is an important issue for society to wrestle with.
Okay. And Ms. Marcelin?
Yes, thank you for the question, Congressman Vargas. Yes, absolutely. I believe that climate change is a real phenomenon, as even not, we have other people than the banking regulators. We have scientists, we have other areas of government that has studied this extensively, and I do think they have access to this information, our banking regulators, as do we, and can then use that information to assess how much of that then flows into the financial system and the risk it poses, and which then falls into their safety and soundness mandate.
Okay. The question took a little bit longer than I thought. That was going to be a pretty simple question, but it turns out to be a little more complicated for some. Not for me. I obviously think there's climate change. I find it interesting that someone would even comment on it. But I do have concerns about Basel III because of what Mr. Scott was talking about, first-time home buyers and the ability to get a mortgage for people who have worked hard, saved up their money, and now are not going to be able to get a loan. Would someone like to comment on that hasn't commented on that? Mr. Honig, I don't believe you commented on that. Why don't you comment on that, sir?
Well, I don't know that they won't be able to get a loan. It depends on.
But I'm saying, will it make it more difficult? I mean, that's the issue.
Basel III endgame?
Correct.
It's not clear because some of the proposals in the endgame favor mortgages for some and
Okay. So you don't think it's
for
clear?
others.
Professor, I see you're anxious to answer this question, Professor Skinner.
I think it's unclear because there hasn't been a meaningful cost-benefit analysis, but I think your question invites commentary on shifts in market structure that can be expected, although we won't know the full extent of it yet. However, I do think a lot of lending will go to different corners of the financial system, and maybe that will be good for first-time borrowers, and maybe it will be bad. But this is a prime example of where we can know that there will be cost and unintended consequences from these higher capital charges.
Marcelin, I apologize. You have only a few seconds. Go ahead.
I also want to emphasize that the majority of mortgage loans, especially to African and brown communities, are securitized by Fannie Mae and Freddie Mac, and they are not subject to increase in capital requirements.
Thank you. Thank you, Mr. Chairman.
Gentleman's time has expired. Gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman. In recent years, the question of whether U.S. banking regulators, such as the Fed, should actively encourage banks to shift away from traditional assets and embrace green investments has been gaining traction. We've even begun to see regulators slowly but surely taking a more active role in this space, implementing overly burdensome climate policies across our financial sector. Yet, it's important to recognize that these agencies lack a formal mandate to encourage or promote any form of transition to, quote, green practices. Earlier this year, Chairman Powell acknowledged the Fed has a narrow role to play in climate policy and stated, quote, addressing climate change seems likely to require policies that would have significant distributional and other effects on companies, industries, regions, and nations. Decisions about policies to directly address climate change should be made by the elected branches of government and thus reflect the public's will as expressed through elections. Following recommendations of the FSOC and international global governance organizations, the Federal Reserve, along with other federal banking agencies, proposed guidance to financial firms on purported climate-related financial risks. Part of that is for the regulators to check whether banks are prepared for the risks of the transition, which could involve, in the minds of some, the elimination of the use of fossil fuels. Similar operational risks are more heavily weighted in the proposed Basel III endgame, representing indirect climate-focused policymaking. Ms. Skinner, What risks do you anticipate as a result of federal banking regulators following the lead of outside international think tanks and climate policy activists in efforts to pressure financial institutions into green policy initiatives?
Well, there are a couple of risks. For one, there are risks to distorting the economy, to pressuring banks to make decisions about who wins and who loses, green sectors winning, brown sectors losing, that ultimately distort lending and, frankly, transition policies over the longer term. There are risks to the institutional legitimacy of the Federal Reserve. The more that the central bank in particular weighs into these politically contested value judgments, the less support there will be for its overall independence. And certainly there are problems you flag with the constitutional design of the FSOC itself. The FSOC is part of the executive branch, and according to the separation of powers, it should not be directing the agencies what to do or which institutions to put within the regulatory perimeter. That should be for Congress.
Do you think the Fed has already overstepped their narrow jurisdiction?
Not yet, but I do think there is a risk for climate mission creep in regard to its supervisory functions, because its supervisory mandate is the least well-defined. Safety and soundness, financial stability, these don't have concrete definitions, and its tools like stress testing and supervision are themselves very opaque and not subject to judicial review.
One of these international governance groups is the Network for Greening the Financial System, a group of over 80 central banks, including the Fed, focused on climate-related risks. The NGFS contends that it is imperative to assess, track, and regulate these risks, which in turn can influence resource distribution and the allocation of credit. Ms. Skinner, do you believe that there is a high risk of increasing pressure from the NGFS and other international bodies to get U.S. banking regulators to increase their active climate policymaking role?
I do believe that there is that risk. Other jurisdictions seem much keener to use regulatory and supervisory tools to pressure their banks in that way. And so I do think the United States is facing pressure internationally to use supervision, moral suasion, to pressure banks to veer away from brown assets and towards so-called green borrowers and against collateral that's green.
Thank you for that. NGFS also allows external financing for its projects, models, and work on data, including from environmental activists and pass-through funding groups with ties to very liberal individuals and groups. Mr. Bashir, given such a funding structure, and given that staff from the Federal Reserve System, FDIC, and OCC have engaged in work groups and other work with NGFS, would you agree that there could be, at the very least, the appearance of a conflict of interest?
I think it's very possible. I know that the Financial Stability Board, for example, created the task force for climate-related financial disclosures, which is chaired by Michael Bloomberg. Again, with the peer reviews, they use each other's peer reviews. And so I think that if they're interconnected that way in their process, I definitely think there's potential that their funding sources could be as well.
Thank you. Mr. Chairman, I yield back.
Gentleman yields. Gentleman from Illinois, Mr. Caston, is recognized.
Thank you, Mr. Barr. Thanks to our witnesses. I want to follow up on a couple questions that have been asked by my colleagues. First with Ms. Marcellin, and then Mr. Bashir. Try to be quick. Ms. Marcellin, you had this conversation with Mr. Sherman about tax equity, and I want to just put a little bit of a finer point on this. Under the proposed Basel rules, at present, if banks invest in tax equity, it's got 100% risk weight unless it's more than 10% of their capital, then it bumps to 400%. Under the proposed new rules, some classes of tax equity would go to 400% regardless of the level, and some wouldn't. So for example, tax equity in community housing still stays under the old rule. Tax equity used for clean energy goes to the new rule. Is it your opinion that there is and to be clear, like I support robust bank capital standards, but is it your opinion that there is a difference in the risk profile of these different classes of tax equity that matches with the differential treatment under the new Basel rules?
Thank you for that question, Congressman. I have to say that I defer to the regulators, and they're in the best position to determine the specific risk weights to those, the various risk profiles of these asset classes. The one thing I will say is that Congress did give a statutory explicit statutory okay to give preferential treatment to housing and low low-income community development programs.
Sure, and I'm not suggesting that we reduce that in any way. I'm just making the point that if the idea of these capital ratios is that, risk should follow.
Yeah.
And if we don't have an affirmative sense that there's a risk difference, it shouldn't be priced differently.
Yeah. The only, thing to add to that, and again, I too support the goal to move to clean, renewable, climate projects. Completely understand the concern there. As you mentioned, there were just weighting the risk between publicly traded equity and non-publicly traded equity, and that's where the tax equity financing fall under.
And I'm sorry to be brief, but I do want to get to Mr. Bashir. But do you think that in a final rule, federal regulators could find a solution that maintains robust capital standards, but still doesn't limit our ability to realize the goals of the Inflation Reduction Act and doesn't differentially risk weight things that have comparable risks?
Yes, they absolutely can find a way to do both, and happy to work with you to do so.
Terrific, thanks for that. Mr. Bashir, in the exchange you had with Mr. Vargas, I understand Americans for Tax Return does not take a position on the science of climate. I suspect you also don't take a position on the nature of communicable disease, but I'm sure you like that when your town invests in clean water. So I want to just talk a little bit of the science to make sure we're in agreement. Do you know what the current level of CO2 in the atmosphere is?
No, I'm not aware.
Okay, it's about 421 parts per million. When I was born, it was 326. So it's grown by 30% just in my lifetime. I'm a little older than you, but since 1993, 50% of all the CO2 that humans have ever emitted into the atmosphere is since 1993. You familiar with a guy named Svante Arrhenius? You ever heard of him? 1800 scientist. He basically he explained what happens if you increase fossil fuel consumption, and what he predicted in 1886 is essentially exactly where we are. It's also, by the way, where Exxon scientists predicted we were going to end up about 30 years ago. You familiar with carbon-12, carbon-13 isotopes and the differential way that photosynthesis works?
No, I'm not.
Okay, plants like carbon-12 better, and fossil fuels that are plant-derived have more carbon-12 in them, and in fact, we can see that in the ice core samples, we are overwhelmingly, the recent CO2 emissions are from the combustion of fossil fuels. So we got the sciences with us. You don't need to be a scientist to know this. I'm not a climate scientist, but it's directly contributing to what's all going on there. Do you believe that climate change poses a major risk to the stability of the U.S. financial system?
So we oppose the government intervening.
Just a yes or no. Do you agree with that statement?
We oppose the government intervening.
I'm not asking what your opinion is on what the government should do. Do you agree that climate change poses a major risk to the financial system? Because that was what the Trump administration said.
The Trump administration could say that. Our opinion is that the government should not be intervening.
Okay, I'm not asking you for your Ayn Rand politics. The Trump administration, they predicted that banks were going to start offloading risk to less sophisticated players in coastal properties. That is now happening. Insurers are leaving these areas. Appalachia is collapsing because the coal country can't produce a product that markets want. That is causing huge flights of capital. So my last question is, do you agree that the Financial Stability Oversight Council has the authority to oversee the financial stability of the U.S. economy?
They were established in Dodd-Frank and have been given certain authorities. But I think with the recent guidance that they issued on non-bank SIFIs.
We're out of time. You have political opinions. Science is real. Capital really is moving, and we have a job to do.
Gentleman's time has expired, and I'm glad the gentleman and I agree that the Appalachian economy has collapsed. Okay, the gentleman from Wisconsin, Mr. Fitzgerald, is now recognized.
Thank you, Mr. Chair. Fascinating hearing people with no science expertise asking questions of people that have no opinion on any of these scientific questions. So I don't know how we devolved to this point. We've discussed quite a bit about how the Basel proposal adopts legally binding capital requirements originating from an organization that exhibits no legal authority in the United States. Yet the Federal Reserve and other financial regulators have the power to adopt these standards without any input from Congress. Mr. Bashir, the Federal Reserve's independence is certainly important for monetary policy decisions, but should Congress be looking at restricting some of their power when it comes to bank supervision, especially in light of regulatory failures over SVB, Signature, and some of the others?
Congress needs to rein in the U.S. regulators. I think that with regard to Silicon Valley Bank, that bank's FOIA.
Right, and the reluctance, shouldn't the reluctance give the U.S. regulators cause for concern about disadvantaging U.S. financial institutions overall, right?
Absolutely. The competitiveness of our banking system, of our global correspondent banking system, and our capital markets is a major national asset, and that should very much be something that the U.S. regulators are concerned with hamstringing.
I want to ask you one more question, but let me premise. The Basel Committee uses a regulatory capital assessment program, right, to determine whether a jurisdiction is a complaint with a particular, Basel standard itself. The problem is that the measurement focuses so narrowly on technical adoption of specific requirements rather than some of the capital levels involved. Aspects of U.S. rules that are similar are not considered in that assessment. I think that's correct. Wouldn't a better approach be to focus on overall capital levels rather than narrow and technical assessment?
Well, a better approach, given that Basel is not a treaty-based organization, it's not any source of formal international law, would be to take a very high-level peer review to the extent that it's done at all, and to see if the spirit of the direction of travel is being complied with, provided, again, that any U.S. instantiation of the Basel principles also comports with U.S. law and fact. As you point out, the peer review looks very specifically for implementation that has a very high degree of enforceability.
So a Basel complaint appears to create kind of an unnecessary redundancy within the U.S. capital rules. How would the U.S. regulators weigh compliance with this international standard when they're proposing a rule in the U.S.?
Well, in the case of the endgame, for example, if that was something that Basel was reviewing, the U.S. would be super compliant. And in many aspects of Basel, the U.S. is either exactly compliant or super compliant. And I think it's important to tease out two different ways that Basel can influence what's happening in the U.S. One way is the strand of the conversation that we've been having with climate.
The time has expired.
Thank you. You bet.
The time has expired. I'm sorry. The gentlewoman from California, Ms. Kim, is recognized.
Thank you, Chairman. I want to thank our witnesses for being with us today. I'm deeply concerned that the Basel III Endgame and the other proposals will make credit more expensive for small businesses, reduce lending for low to moderate income households, and put our banks at an international competitive disadvantage. Furthermore, it's been reported that certain European countries, they won their carve-outs on their own Basel III Endgame proposals to protect their banks from the increased cost of higher capital requirements. And unfortunately, here, the SVB failure is being used as a red herring to increase capital requirements by as much as 16%. And we know that the SVB's failure was largely due to bank mismanagement and an old-fashioned bank run that was enabled by new technologies and supervisory failings at the Fed and the California Department of Financial Protection. I want to ask the question to you, Professor Skinner. The one reason for internationally harmonized capital standard is the establishment of a level playing field for competition among banks from different countries. And this is often cited for requiring U.S. banks to comply with Basel III Endgame. However, isn't there a difference between international harmonization and Basel compliant? And are there other jurisdictions adopting standards that are comparable to other U.S. or the Basel?
Thank you for the question. So in much of the history of the Basel Accords, the U.S. has complied or gone further. And so I think you raised a really important question, which is why now is the U.S., I think a better phrase would be platinum plating the Basel standards, because there stands to be, if the rule is implemented as it's been proposed, quite a discrepancy, in particular with regard to loans to corporates between Europe and the United States.
It seems to me that Basel III Endgame will make regulations more centralized and move us away from market-based system to more utility system. So in your conclusion, you alluded that there was an attempt to remodel the U.S. financial and banking structure as a public utility. So can you tell the committee what type of U.S. economy it will look like, or we can expect, if the banks make business decisions like utility companies?
Well, it will look more like a centrally planned economy, and that is essentially a vision that many academics who have influence with regulators believe is the correct vision for banking market structure in the United States, one that is much more centrally directed by regulators' opinion of what is or is not a credit risk, and essentially using banks as mechanisms for allocating capital toward preferred or away from less preferred sectors in the economy, rather than letting banks make their own decisions about risk.
How is our financial and banking system different than other countries like European Union or in Asia?
Well, one key way that our banking system is different is that we have what is known as a three-tiered model, where we have community banks, regional banks, and large banks. And that's considered to be a major strength of our banking system, because the banking system is able to lend to many different pockets of the U.S. economy and serve many different risk profiles, which overall makes the financial system more resilient. And the concern with Basel III is that we may devolve to a two-tiered model with very large banks that can stomach the cost of these additional regulations, and community banks which are exempt.
Thank you. You know, my sense is that countries in those regions are influencing the Basel Committee to enact standards that look more like their own standards rather than our own American standards. Mr. Basha, let me ask you the last question. The Fed's Vice Chair Barr claims that the proposed rules only apply to the largest banks with over $100 billion in assets. But in your written testimony, you mentioned that the negative implications can trickle down to smaller community banks. So can you elaborate on your own written testimony to that effect?
So for the market risk component, that's one of the exceptions, in that if a bank has trading assets and liabilities of more than $5 billion, then folks don't understand is that a lot of the community banks that are out there actually use larger banks to be able to issue those cards. So I think that the effect will end up trickling down, even though it's framed as applying to only some of the largest.
Gentleman's time has expired. Gentlelady's time has expired. The gentleman from Texas, Mr. Green, is recognized.
Thank you very much. And I'd like to thank the witnesses for appearing. And Mr. Chairman, I'd like to thank you for presenting a panel that looks more like America. I have been critical in the past, and I want to compliment you for the optics. We do have gender balance. And I'd like to compliment the Democratic staff, because we tend to balance when it comes to ethnicity. So, Mr. Chairman, I hope that this is taken in the spirit that is given. It's not enough for things to be right. They must also look right. And this looks a lot better than some of our all-white panels that we've had. Thank you, sir. Now, with that said, Ms. Marcellin, and if I'm not enunciating properly, please let me know.
That's perfect, yes.
All right, thank you. U.S. regulators, are they not a part of the international organization that we have come to know as Basel?
Yes, they are.
And do they have a fair amount of influence when decisions are being made, or are they excluded from the decisions? They deliberate, but they don't have a voice when it comes to making decisions?
Thank you for that question. You know, the Federal Reserve is the largest and most powerful central bank in the world. When the Federal Reserve speaks, people tend to listen. The idea that they are, you know, as someone said before, a standard taker and not a standard maker on this global body is, I would say, a very creative view. Not to mention, unlike other countries who have one or two of their prudential regulators, the United States has the Fed, the OCC, the FDIC, and the New York Fed that sits on the on BCBS. So we have a very large amount of influence on this body.
Perhaps it's the name that confounds and confuses. Perhaps if it were called the U.S. Committee, we could embrace it with a greater degree of alacrity. But be that as it may, let's continue. There's this notion that we don't need any additional capital for our banks. Can you give us a discussion, just briefly if you would, on the downward trends in capital for the GSIBs that you've seen since 2017?
Yes, thank you for that. You know, with the advent of the pandemic, there was a lot of, obviously, to mitigate the crisis, you know, regulators stepped into gear and did emergency measures, which, you know, put a downward pressure, as detailed by the Kansas Fed, on capital ratios, and even lower if you look at just the supplemental leverage ratio. Not to mention, the Fed also excluded Treasury securities from being counted as part of the denominator for the SLR. That rule has expired, and yes, we're seeing a trend of capital rising a bit at the largest banks. However, you know, as academics have pointed out, including, you know, right-wing academics as well, Mercatus Center and others, that we are nowhere close to optimal levels of capital. If we look at the tier 1 risk weighted ratio, that's estimated, the optimal level for that is estimated to be about around 23%. Right now, we are looking at like 14% around for the average for the largest banks.
Thank you. Final question has to do with performance. Have you found that banks that are better capitalized perform have a better performance record than those that are less capitalized, or are they about the same, perhaps?
Yes, thank you. I would defer to people that are, I consider much smarter than myself, including the Bank of International Settlements, like I said, many regulators, many academics as well, that have shown time and time again that banks, you know, even if we look back to the financial crisis, before the financial crisis, banks that were better capitalized were able to deploy their capital and deploy sources of lending to an economy that was being restricted. And we saw that even with 2009 when the Fed went and implemented stress tests. And what was it, 11 out of 19 banks failed? And then they actually went and required them to access TARP funding, which then, you know, started the U.S. banks having a more resilient system than the European banks, which took a longer time to recover from the global financial crisis.
Thank you, and Mr. Chairman, I yield back.
Gentleman yields. Gentlewoman from Texas, Ms. De La Cruz, is now recognized.
Thank you, Mr. Chairman, for holding this important hearing today, and thank you to the witnesses for being here. Mr. Bouchard, what control does the United States have over the Bank for International Settlements, the Basel Committee on Banking Supervision, or the network of central banks and supervisors for greening the financial system?
The U.S. regulators are, the Federal Reserve is a member of the Basel Committee on Banking Supervision. In terms of control, that's unclear exactly what that would be necessarily, just because they're members, they all have these meetings, they go through these different frameworks, but again, it's very opaque, and we're not entirely sure what's actually discussed in those meetings.
So, being the House of Representatives and our responsibilities being oversight, do we have access to what is discussed in these meetings and what thoughts are collaborated and perhaps influencing our banking system?
I'm sure that those minutes are somewhere, but they are not available to the public, and I think that they should be, given that the current rule that has been issued and the comment period closes mid-January, given that it's outstanding right now and the magnitude of it. I think that the public and the elected representatives of the American citizens should be able to at least see what was discussed, which members were wanting what provisions, and how they came to those conclusions. The executive branch does not make the laws, you all do.
So how do we know if they're actually working in the best interest of American citizens and small business owners?
We're not entirely sure. I think it's all this opaqueness that has been allowed to go on for years now, since the first Basel Accord was adopted in 1988. It's been allowed to go on for a long time, and I think that it's great that we're having this hearing to shed light on this.
So ultimately, what I'm hearing is that there is no oversight by Congress, that we don't know if they're even working in the best interests of the American citizens. And quite frankly, we have international bureaucrats that are implementing policies that we just don't know how they affect Americans. Is that correct?
That's correct. I think that the rule that as it exists now is just it's an example of what the regulators have decided they want to do, what they believe is their unbridled discretion, which again, they do not have unbridled discretion, but they, for whatever reason, believe they do. And it's hubris, frankly. I think it's a lot of hubris, and that they believe they know what's best for the system, when in fact they forget that they have not been elected.
No, they have not been elected, and they don't have any oversight from Congress, which is unacceptable. Ms. Skinner, I know you have written about central bank activism. What reasons have you found in your research for why federal banking agencies are becoming more activist in nature?
Thank you. Yes. So I think the primary reason is that there is a perception internationally and among some segments of the public that central banks should tackle more and more areas of economic importance. There are lots of areas that are important to the economy. Most of them don't fall within the jurisdiction of the Fed. And so for those that are dissatisfied with Congress, would like to see more legislation in a particular direction, central banks, their balance sheets, their supervisory tools can be very attractive to try and capture and direct toward a particular policy outcome that they would prefer. So effectively, central banks are being pressured and sometimes volunteering to do it themselves to be more activist, essentially to get around their mandates and accomplish things in the economy that they can't otherwise do within the four corners of their mandate.
And what does this mean for the American people?
Well, it means that the American people will ultimately have less input into what their economy, what their society, what their political system looks like, which is why when we refer to the fact that central bankers are unelected, what that effectively means is that they can't be wading into these waters and making these subjective value judgments that we reserve for our democratically responsive institutions, because central banks are not democratically responsive institutions.
Thank you. I yield back.
Gentlelady yields back. The gentleman from Tennessee, Mr. Ogles, is now recognized.
Thank you, Mr. Chairman, and thank you all for being here. You know, Mr. Chairman, in regards to the Appalachian community, there has been a hardship on Appalachia. When you look at the three major basins in Appalachia, you know, in 2005, they produced almost 400 million short tons of coal. And because of ESG, because of overregulation, that's down 65%, or a little over 65%, to just over 100 million short tons of coal. This has had a negative impact on that region, on our economy, and the science is real. The science is that the United States of America produces the cleanest energy in the world, whether it's oil, whether it's gas, whether it's coal. So if their agenda was truly to fix the economy, to truly fix the environment, they would focus on making us energy independent again. And having this kind of rhetoric coming out of this committee is nonsense. And I get back on point, Mr. Chairman. I thank you for your indulgence. You know, we're talking about Basel III and the end game, and you look at the international standards and the compliance thereof. You know, we have a dynamic banking system, as you stated, a three-tiered system. And with our push to comply with the European standards, in essence, a more rigid standard, a less dynamic standard, I see a world in which an actor, a foreign actor such as China, such as Russia, could try to leverage those standards that would have a negative impact on the United States, while leaving their systems unharmed, or they quite frankly have no intent on complying. All while, because these are international standards, you have a world where China is politically moving against Taiwan. So they have a reason to want to undermine our economy. You have a world in which Russia is attacking Ukraine. They have an obligation to their people to try to undermine the United States so that they can leverage that in their own negotiations for territory in Ukraine. You now have the conflict in Israel, a global conflict where Russia and China seemingly are on a different page than the United States of America and Israel. So I would ask Mr. Beshear, is there a scenario where Russia could use standards to negatively impact the United States of America while leaving themselves unharmed, yes or no?
It could definitely be a possibility, and I think that's why we need the legislation that's currently been presented to be enacted so that we can see if that's actually occurring.
Mr. Honig?
I think it's a I think it's a risk in the following sense that we agree to these standards, the U.S. complies, and they do not. It favors them, and it handicaps us in a relative global situation.
Which, to your point, would be self-inflicted on our part, Ms. Skinner.
And that's why I don't like the Basel standards, period.
Right, roger that. Ms. Skinner?
Well, other jurisdictions certainly seem to be mindful of their own competitive position. And again, we can't know what their objectives are for the United States because we don't know what their negotiating aims are or who the people participating are.
And to your point in your previous testimony, we've seen where the European Union has actively pushed back on regulations that would have a negative impact on their economy or their banking system. Meanwhile, we tend to go over and beyond a system that is literally working against our banking. Is that a fair assessment?
That's a fair assessment, yes.
Yes, ma'am. Now, going back to China, which is really, I have a bone to pick with China. I tend to be one of the more vocal folks, along with some of my fellow colleagues on this committee, against China. I think they are the existential threat to the United States of America, whether it's from a military standpoint, whether it's from an economic standpoint. We know that they're working with the Mexican cartel. We know that they're flooding our streets and our children with fentanyl. Is there, the same question, Mr. Beshear, a scenario where China could undermine the United States of America, whether it's through green initiatives, et cetera? Meanwhile, they're one of the larger polluters in the world, that they could try to undermine the United States of America while leaving themselves unharmed.
If their goal is to increase regulation and hamper our banking system, and they have, then I think with this rule that they have, if to the extent that they have weighed in on this, which apparently they have, if they're members, then I think they've succeeded in trying to do that.
Mr. Honig.
I think to the extent, for example, that they agree and, shall we say, negotiate hard for green energy rules that then they ignore and ship their a dirty environment to us, yeah, I think that undermines the United States.
Ms. Skinner.
Yes, well, if we look at how China has behaved in other contexts, such as economic cyber espionage, then there is reason to think that there is a risk that they would use other opportunities to undermine the U.S. economic interests as well.
Mr. Chairman, I would just close by saying we have both Russia and China have proven to be foreign actors, bad actors who try to undermine the United States of America. And our participation in Basel III is ludicrous, and the fact that we're complying with countries that are trying to undermine us is a fool's errand. Mr. Chairman, I yield back and I thank you.
The gentleman yields back, and I'd like to thank our witnesses for their excellent testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. I will have one for each of you, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing